Hi, today I'm going to discuss part one of the buying process. And to me, part one is understanding the components of a mortgage. So today we're going to go over the key components of a mortgage so you understand what a mortgage is and how it's composed. Now, the first thing whenever we're talking about a mortgage is the amortization. And the amortization is the period for which you're going to have the loan. Generally speaking, the most common amortization is 25 years. You can get a 25-year amortization on any purchase just about. Doesn't matter if you put 5%, 10%, 20 or more, you're allowed to do that, okay? So I'm gonna write that down, 25 year. Next, you have the option of putting a 30-year amortization if you put a minimum of 20% down. So if you do put 20% down, you can extend the mortgage to 30 years. The benefits of this is that your monthly payment is gonna be lower. The downside to it is that because it's amortized over a longer period of time, you're gonna pay more interest over the course of the loan. I personally usually recommend young families, couples, anyone getting their first property to go with a 30-year amortization because the monthly payments are lower. And by doing that, you're gonna be able to get more accustomed to actually owning a home, the maintenance associated to it, and gives you a little bit more cash flow. A lot of the times, most people don't hold a home or the first property until the end of the amortization as well. So while you're first getting started, it's always best to have a little bit of extra money set aside or to have it available in order to deal with any things that might come up. Now, the second component of a mortgage is a term. In Canada, we have the term. The term is super important because that's the period for which your mortgage terms are going to be locked in for. Now, the most common term is the 5-year term. You'll sometimes hear banks offer you a 1 year, 2, 3, everything in between. I have seen banks go as far as a 10-year term as well. But generally speaking, in Canada, the big banks are offering you the best rate versus term on the 5-year term. That's kind of the period of time that they're most comfortable with, okay? So the term can be anywhere from 1 to 10 years. However, the most common one is the 5-year term. I'm sure you've seen that on their windows or on their advertisement. It's what you hear all the time, okay? Now, interest rates are the next component. Interest rates get broken down to two different types of interest rates. We first have the fixed rate. And the fixed rate is you buy a property today, and for the term, so for that 5-year period, your terms are not going to change. Your interest rate's going to be locked in for that period. Okay. Today, a 5-year fixed rate is about 5.19. Interest rates go up and down every single year. Last year, the 5-year fixed was about 1.98. So today it's currently September 2022. Rates might change again. We've seen rates go up and down all the time, but this is just for context right now. The next type of interest rate we have is the variable rate. Now, the variable rate is interesting. The variable rate is based on prime. So prime is an interest rate that the Bank of Canada decides and determines. Today, prime is currently at 5.45. And what banks will typically do is they'll offer you a discount. So they'll give you maybe 0.45 off right now, and your effective rate would be about 5% with the most recent increase, all right? So people will tell me, oh, that seems too high, that seems too low. It really comes down to your risk tolerance. I personally am usually going to go with variable because I'm okay with riding a wave up and wave down because I know that over a 5-year period, historically, variable is always cheaper. Now, a lot of times you're going to have to hold on to your seat because especially in the last few months, it's gone up, 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 and most people get really, really nervous. But I have a strong feeling that in the next 6 to 12 months, when rates start to come back down, the variable rate is going to be cheaper than the fixed rates will be at that time, and we'll go back to a much more balanced interest rate market. So that's the basic components of your property. You have amortization, you have the term, and you have the interest rates. With that, you're going to be able to understand what the bank is offering you and how to make the best choice for yourself.